of a sudden they're buying a third to almost half of yearly mine production. That's mind-boggling, Jim. I mean, it really, when you think about it.
Either party after crossing 40 trillion in debt. I don't hear anybody in Washington talking about this issue. It's like it doesn't exist.
It's only going to happen when there will be a crisis, when gold will be 17 or 25,000, and unemployment will be 10%. When I look at gold, it's all upside.
You're watching the Financial Sense News Hour. Financial news for high net worth investors and strategists. When it comes to the biggest investment trends and understanding the market, we've been delivering the insights you need for over 30 years.
Well, since the bottom in gold in June and July, the price of gold is up 15% in the month of August alone. Is this the next leg up for gold? Well, let's find out. Joining me on the program is Pierre Lassonde. He's chairman emeritus of Franco-Nevada, and he's managing director and principal of Firelight Investments. Pierre, you and I are old enough to have experienced the bull market in gold in the 70s, where we had conflict, the severance of gold from the dollar, problems in the Middle East. Then we had another bull market in the 00 decade, and of course, the current one. As you look at these bull markets, how would you contrast where we are in this bull market compared to those of the past?
First of all, thank you for having me on your show. Much appreciated. It's always a pleasure. I know it's been quite a while, but always a pleasure to be back, Jim. So thank you.
You're welcome.
The French philosopher Voltaire once said, history never repeats itself. Man always does. And it is incredible to me that 50 years after the last bull market in gold, I mean, a true giant, I would say the 71 to 1980 gold bull market is equivalent to the 1929, 1934, if you want, which was like, very short because essentially the American government took over gold. But when you look at the circumstances, they're very similar. The price of oil back then went from $3 a barrel to $40 a barrel. Actually, it topped over 50. And that fueled inflation everywhere in the economy because everything that you eat, that you do, it's all about energy, okay? You need energy to do everything, to get your food on the table, to go to work, to everything you do. And at the same time, we had the remnant of the Vietnam War, okay, which costed, like a lot of money. And so when you look at what's happening today, and frankly, I would have never believed that you could have, recreated circumstances so close. But when I look at what we have today, we have a war in Iran that, the White House doesn't know how to get out of. The price of the pump is like over $4 a gallon. Here in Europe, where I am right now, it's $8. Okay, believe it or not. I mean,
Wow.
that is really expensive. And on top of that, again, you have tariffs that are being put on everything. That just adds on to the costs of like everything that you buy. From anywhere, not just from Canada, from China, from every other country. And the biggest difference between the 1970s and today is the fact that in the 70s, hey, believe it or not, in 1980, the US federal debt was 938 billion. Today it's 40 trillion. Okay, the capacity of the US federal government today to respond to any shock in the economy has disappeared. And this is where the market is being very jittery. I mean, you look at what, Treasury Secretary Bessent did. He tried to calm the nerves by, starting buying the long end. All it did, he actually did exactly the opposite. And people can see right through the game here. And what we have is inflation for higher and for longer. And that's what the bond market is telling you. That's what the gold price is telling you. And until we have a change, I believe, in the White House, because, even if the Republican lose both the House and the Senate, which I don't think they will, but even if they were, it's not going to change President Trump. Okay. He's going to keep on going just like because he doesn't care. So I see a world where more and more US dollars are being dumped, by Japan, by China, onto the market. The Treasury, if they don't want to see interest rate at like 8, 9, 10%, will have to buy it back. It's highly inflationary. And that's what the gold price is telling you, is that you're going to see higher gold prices over the next 2 years. And in a presentation in October last year, I predicted you're going to see gold over $17,000, and I think you will see that sometime in the next 3 years. That's
Wow.
my view of things right now.
So, it's interesting. I'm looking at a Bloomberg graph I have of gold in all the major, probably the top 25 currencies in the globe. And over the last 12 months, Pierre, gold is up anywhere from 25 to over 50% in 1 year. I
Hmm.
mean, we don't even see stocks up like that that often. So
No. And
it
the
seems,
fact is, I mean, Jim, if you taken all your money in January 2000 and buy, kilobars of gold, today you would be better off than anything else you could have done in the market. You'd be better off having done that than buying the Dow Jones, buying any indices that you want, buying anything in the financial world. You would have done better with just gold bars.
I just wonder if what we're seeing now, Pierre, is gold is becoming money because if you look at central bank balance sheets for the first time, I think it was this year, gold now outweighs treasuries in central bank portfolios. And we see, for example, in China, where they're using trade and they'll settle the balances in trade in gold. Is it not becoming money again globally?
Yeah, so I've always said that gold is the anti-dollar, okay? When the US dollars perform its function of currency of last resort, you don't need gold, okay? And there are times like in the 80s, I mean, if you want to know why the gold price went down from 650 to 250 by 2000, is that you had a repeated administration, including Clinton, who had, budget surplus, okay? Well, at that time, you don't need gold, okay? Because the dollar performs its function. But when the dollar doesn't perform its function, then that's when gold turns into a currency. And you are absolutely right. This is what we're seeing right now.
So I want to turn our attention now to the mining companies and once again talk about the contrast of mining companies today because I remember the decade where there were a lot of acquisitions made. They didn't pay attention to the price they paid in those acquisitions. Would you say the mining industry has gotten more disciplined in your opinion when you look at what companies are doing today?
Yes, far more. And but it's also a function of what the public is willing to pay for. So, I mean, I don't want to put the blame entirely on all the executives that went through the 2002 to 2015 bull market. I was president of Newmont at the time, and I remember clearly the demand was for, any production at any cost. And so the industry responded by doing stupid acquisitions, and they had to take like, huge write down at the end of the day. Today, the shareholders are asking financial returns. So the discipline that the shareholders is asking is very good for the industry, and the executives are responding accordingly. So what you're seeing is dividends and buybacks, and the few acquisitions that have been done either at market or very close to it, which is all in the interest of shareholders. I mean, for example, we just did the merger of Orla, which is one of my companies that I created 11 years ago with Equinox, and we did it at market. And we've created the second largest gold producer in Canada, and in 5 years, one of the top five in the world. And we did it so that all the shareholders are winning. Okay. And that ethos, I guess, is, with all the current executives. So you're absolutely right. I think that owning shares of, at least the producing companies, whether it's like Nico Eagle or, or Newmont, they have been very good steward of their shareholders' money.
I want to talk about the supply side because one of the things that we've seen in the oil industry over the last decade or so, there's been an underinvestment. The oil companies were focused on shareholder buybacks, increasing dividends. How would you contrast that to what was going on in the mining industry? Have those same needed investments been made?
I would say that generally speaking, yes, it's been made at a pace where the increase in annual production of gold is between 1% and 2%. And this year will probably be closer to 2%, but it's not going to be like 5 or 10%. You're never going to see that in the gold world. I think the oil business also has another issue, particularly in the United States, where they're running out of, like basin that are incredibly productive, and then now they're into the secondary and tertiary, basin, and that's a lot, more difficult for them. But in the gold business, the time but between finding an ore body and putting it in production can be anywhere. I mean, at the shortest possible, I would say you're looking at like, 7 years. And if you're looking at, jurisdiction that have, very difficult environmental protection laws, you could be looking at 12 to 15 years. So that's kind of the range that you're looking at.
Yeah, S&P Global is talking about anywhere from 12 to 15 years bringing a mine into production. Let me ask you this, when you're looking at a mining company, a lot of times they get into jurisdictions that can be difficult. Mexico, Nicaragua. How does a mining company handle where you have a prolific mine, very profitable, but you have problems in the jurisdiction it's in?
Well, the first thing I would say is, do you have the protection of the law in terms of ownership of the property? Okay, that's first. If you don't, like in Russia, for example, okay, forget it. Don't go there. Okay, like, But two, if you have a really, really great deposit that can, essentially afford you to be down for 3 months and to have all kinds of issues, you don't want to walk away from that. I mean, it's too good. Okay. Like there's so few great, great deposits in the world that you don't want to walk away from that. And therefore, you put in place, what you need to function in that environment. And as a mining company, I say the minimum um, operation that you should have to have a truly balanced company is you have to have at least three mines in three different jurisdictions. And that way, if one doesn't quite go, the other two can take over. And as a company, you are able to respond. If you have like one mine in one jurisdiction, they shut it down, you're done. Okay. Like, you have, and for all kinds of reasons. And we saw, for example, Franco, when I was at Franco, Nevada, we had a sterling record. We never had a mine that was taken away from us, that was, impounded, that was stopped, or anything like that. And then comes Panama. And it came out of the blue. Like nobody could have ever thought that a country like Panama, 2 point some million people, like were able to, like a 10 billion investment and, stop it. Like it came out of the blue. I think it will get going again, but as a manager, you have to think as a portfolio manager. You have to have like one of this, one of this, one of that, and that's how you manage a company.
So when you look at the price forecast for gold, I've seen even Goldman Sachs is talking 6 or 7. You mentioned in the next couple of years you could see 17,000. What do you think is going to be the driver of that? Is it going to be sovereign debt?
Yeah, essentially, I think that what we will see, and again, if you go back to the 1970s, the last 4 years of the gold bull market, you saw inflation go up every year, you saw interest rate go up every year, and right in the back of it, you saw gold going up with it all every year. Okay. And the reality of interest rate is that the real rate of interest were negative right through the piece. And when you look at the short-term interest rate today, the real rate of interest is negative. And the gold price always thrive in an environment where the gold price, where the real rate are negative. And on top of that, you're seeing a de-dollarization of the world finance, and gold is, replacing a lot of. And you mentioned, for example, the central banks. Well, central banks up to 6, 7 years ago couldn't care less about gold, and then all of a sudden they're buying a third to almost half of yearly mine production. That's mind-boggling, Jim. I mean, it really, when you think about it, when I was chair of the World Gold Council, we had to go to the central banks and beg them not to sell. Okay, like they were dumping gold in the market and they were like, depreciating their own currency. And like we had to, do a memo and then have them sign that they were not going to sell more than 500 ton collectively a year. And now, like, they're buying. Why? Because they don't want to own so much US dollar. And they're in the predicament where they see the US dollar is going to go down vis-a-vis, all the other currency. But, what's the world currency that it goes down against? It's gold. And that's what's going to happen.
You were the pioneer of royalty companies, and I have an interesting story I'd like to share with you. In the 90s, I think it was 1993, I saw an opportunity in gold, and I bought gold stocks for my clients, made a lot of money. 1994, Greenspan doubles the Fed funds rate. I gave back all of my gains in the following year. But then a couple of years later, I discovered your royalty company, Franco Nevada, and held that until it was bought out, I think it was 2002 by Newmont. And
Mhm.
I made money for my clients during that period of time holding royalty companies. So, what did you see in royalty companies that caused you to go in that direction versus just say pure mining?
So the royalty model, Jim, is to me the best business model on the planet. Okay. Pure and simple. And the reason for that is that you get free optionality. And I say to people, give me free optionality, I'll make you a millionaire. And in the royalty world, there's two forms of optionality. First, there is price optionality. So if you own 4% royalty on, producing 10,000 ounces a year, for example, well, when gold was $600, you would get $600 for your 10,000 ounces. Gold at $4,500, all of a sudden you're getting, like think of the multiple you're getting just being a royalty owner. That's a form of optionality that really pays off. The other form of optionality is land optionality. So the operator will spend a billion, 2 billion, I don't know, like enormous amount of money to put an operation together to build all the plant and everything else, build and bring the machinery. And they'll mine the first 5 million ounces. And then guess what? They will keep on drilling to keep, the investment coming. Well, all the drilling that is done is at no cost to the Franco-Nevada shareholders. And yet, if they find another 5 million ounces, guess what? At no cost to them, they get more money again. And that's another form of optionality. And I tell you, like when we bought back Franco-Nevada from Newmont in 2008, there was 10 million ounces of reserve and 20 million ounces of resource. Over the following 10 years, all of that was mined out. And at the end of 20, 10 years later, 2018, 2019, we had about 12 million ounces of gold in reserve and about 30 million ounces in resource, all at no cost to the Franco-Nevada shareholders. That's the key here, is that there is no input in terms of cost. And that's why when you look at Franco-Nevada, you have revenue like, 1.5 billion, and then cost is like about 10%, and like net profit is like 90% pre-tax. It's unreal. It's the best business model in the world.
When you were dealing with mining, you mentioned something. If you're a mining company, it's good to have, let's say, 3 or 4 mines in different jurisdictions. So if something like Panama happens, it doesn't shut down the company. So how do you deal with when you're in that kind of situation? What is the possibility as the price of gold goes up? Some of these countries get a little bit greedy. They start changing the sharing arrangement. How do you deal with that? Because it's a
It,
reality.
it is a reality, and it's happened already in Mali with B2 Gold. It's happened in like various countries in Africa. We haven't seen it yet in South America. We've seen changes in the mining code, but not confiscation. In some of the countries in Africa, what they're doing, it's almost confiscation. I wouldn't call it, but almost. And I mean, on a personal basis, like all the companies that I'm associated with, we just clearly stay away from any country that have these tendencies, I would call them. Um, you talked about Mexico. Mexico has been mining for 400 years. They have an incredible mining culture. They have people who work hard. They understand mining, but also, there is delicate issues with the ejidos, the people who own the land, and you have to understand that, and you have to spend the time with these people to make sure that, their farms and everything else are not going to get impacted. And then in some cases, unfortunately, there's the cartels, okay? And, I think with God bless, Mr. Trump, I mean, the intervention of the US government in Mexico over the last year and a half has been very beneficial to the mining industry simply because they've restored law and order, where sometimes it's very sketchy.
So when you take a look at, I want to move to another metal for a moment, and that is silver. It's a byproduct of mining. What are your views of silver, given where you think gold is going?
Well, let me just, not a bit correct you. Like about 30% of silver is primary mining. And like in Idaho, for example, in the Coeur d'Alene, and there's in Mexico, there's like clearly silver mines. And then 70%, about two-thirds, is byproduct. It just comes out no matter what. The primary use of silver is industrial, okay? Mostly solar panel. And as the price of silver goes up, what you're finding is a thrifting. The Chinese are really good at thrifting, and they look at other metals that will do the same job, and but with a cost of like 1/10 of the cost of silver. And so I think that in terms of the price appreciation of silver, it's going to be, somewhat limited unless the central banks decide that there's not enough gold on the planet. They're going to use also silver as a second currency. I don't see it right now. There's nobody talking about it. But could it happen? It happened in the past. Okay, like silver was the silver dollar and everything else. Silver was a currency. But right now, the only evidence that I have is only gold is being used by the central banks.
I want to talk about downside risk. You talked about gold in the 80s and 90s. The dollar was performing, the budget was balanced under Clinton, so there was no need for gold. Do you see any, I just pure, I can't see the dollar uh, regaining its status and balancing the budget given where we are right now. I think the latest figure I saw by 2028 or 2029, we're going to be at 50 trillion. in debt in the U.S. And
Well,
that,
and not only that, Jim, but by 32, both the Social Security Fund and the Medicare Fund are running out of money.
yeah,
Okay, and there's absolutely no will in Washington to address the issue. I mean, that's the part that really gets me is that neither the Democrat or the Republican have any will whatsoever to address the issue.
that's absolutely amazing because this year is a midterm election year, and neither party, after crossing 40 trillion in debt, I don't hear anybody in Washington talking about this issue. It's like it
No,
doesn't exist.
no, no. But let me add one more thing, okay? The United States, over its history, has, a habit of walking right to the edge of the cliff, but they have this incredible ability to walk back. Okay, like, as a country, America does come together in like absolute dire need. Unfortunately, we're not there, and unfortunately, it's only going to happen when there will be a crisis, when gold will be 17 or 25,000 or whatever, and unemployment will be 10%, and then there will be an administration that will come and do it. But right now, I don't see any will whatsoever, and that's why, when I look at gold, yeah, it's all upside. There's no downside.
So let's talk about the relationship of mining to the price of gold, because mining is leverage. Obviously, from a cash flow, if you're selling a product and that product is 4,000 and the price of gold goes to 8,000, the amount to the bottom line is enormous. So you get that leverage effect, 2 to 3 times the price of gold. So let's talk about the miners for a minute.
Yeah, I mean, like, I love to say that in 1976, my partner and I, we bought Free State Geduld, which was a South African gold stock, for $5 a share. By 1980, it was 105.
Wow.
Okay, this is like 20 times your money, uh, because it was essentially reef mining. They could not, increase the production. The cost was the same, even though inflation was eating everybody else. It was just electricity and manpower. And in South Africa at that time, people were paid like, like a piece of bread. I mean, like almost nothing. So they were making enormous amount of profit. The same environment today you can see in some of the higher grade gold mine that we have around the world. And I would say like Lundin Gold, for example, Fruta del Norte, it's like almost 10 gram a ton. I mean, that mine, is making money hands over fist, but it's not just the only one. And I think that, yes, there will be a bounty. The mining company will end up paying special dividend and whatnot. But the amount of stuff that they can buy is so limited that I do think that you're going to see higher and higher return to shareholders.
Is there any technology, Pierre, in the mining industry? Like we saw oil production in the US was declining until they discovered horizontal drilling and fracking. Now the United States is one of the largest oil producers in the world. Is there anything on the horizon in the mining industry where they can perhaps get more gold out of the ground with some kind of technology, leaching or whatever it is?
Well, the recoveries already are in the very high 90s. So it's really difficult to see how that will change much of anything. And even AI is very good for the exploration business, because it's able to put all of the black box that the geologists have, like geophysics, geochemistry, field survey, and they can put all that in there and essentially, tell the what you end up with is a better black box, okay? But it's still a black box. At the end of the day, you still got to go drilling. There's nothing you can do until you drill. And that's not going to change. There's nothing that's come up, and I think that will come up in the next 50 years that's going to change anything. Yes, the industry is getting better. We have mechanized mining. A lot of the mines, for all the uranium mines, for example, Jim, are there's no people there. All the underground is all automated, and there's like two guys sitting on top with joysticks, and they get all the stuff running around. And you have trains that are automated and trucks that are like no drivers. So the industry has gotten far more efficient, uh, but has anything transformative on the horizon? No, I don't think so.
I want to talk about something that is controversial, and that is gold confiscation. We saw that in 1933 with Roosevelt. Sometimes people raise that. Would the U.S. ever even consider? I mean, in 1933, people turned in their gold coins into the bank and they got deflated dollars or depreciated dollars in return. I just, Pierre, as I take a look at the people that own gold today in the country, my friends, people I know, investors, I can't see them willingly walking into a bank and turning in their gold for depreciated dollars.
No, that's not going to happen. I mean, you have to remember that back then gold was money. Okay. And so what the U.S. Treasury, what they were trying to do essentially was to create more paper currency. So they got the gold, they were able to issue paper currency against it. Today, they don't have to do that. They just print it. Okay. Like, the standard has changed. We went from a pure gold standard today just to a paper standard. So the U.S. government today doesn't have to get your gold. It's just issue papers.
So you've been involved in this industry for quite some time. As you look back over your career, what are the most meaningful things that you have learned through experience investing in gold? The things that really impacted you and the decisions that you made.
I would say, Jim, that the quality of people at the top is like number one, the knowledge. When you look at mining companies today, and as you did back in the 1970s, 80s, and I've seen the Noranda of this world, the Falconbridge, the great companies, and the talent that was involved in these companies made them what they are today. And again, today, like Agnico Eagle, for example, they're the gold standard. I mean, like these guys are absolutely the best in the industry for their shareholders, for the community in which they operate, and so on. So that's my number one. Number two, of course, is the ore body themselves. Okay, like Barrick back in the 90s, like Gold Strike. I mean, was an absolutely incredible ore body. I think that 4 Mile is another one of these incredible, like, 30, 40, 50 million ounce ore bodies. These are the type of ore bodies that create companies and creates legacies. And they're very few. They're very few. And then the final thing I would say is, um, like 2 years ago, I sold my house and I was cleaning up my office and I was pulling out files and I was looking like, oh my God, like, why did I put money in that loser company? And that's terrible. And then I pick up another file. Oh my God, what did I think of? Okay, like, and I realized that, I've made so many mistakes, but it only takes like one or two huge winner to pay not only for all your mistake, but to make, a lot of money. Because mistake you will make, okay? Like there's no if and buts. But you have to recognize your mistakes very early and limit, the amount of money that you're going to lose. And that was one of the things that I learned going through all these files. And I can't tell you, Jim, how many, like, I mean, it's just like, and I guess, in a bull market, all the, when the wind blows, all the turkeys fly. But um, with the juniors, the issue is when the market turns down, they go no bid, and then you become a stockholder. You're stuck. Okay. And that was the one of the lessons, I guess, that I learned. And today I concentrate my investment in essentially five companies that, I've helped create and nurture, and I've put money, and I know the management, and that gives me immense amount of pleasure. And also, it's been great success.
Looking into, I was doing some research on your background, Pierre, and I think you wrote a gold book about
Okay.
gold investing. When was it 1990 or when did you write that? And are there copies? Can you still get it?
Yeah, I wrote that in 1993, and it was a summer where like there was nothing happening, and I had been putting together a file, like one day I'll write it, but well, that was the day. Okay, I sat down and said, I told my partner I'm off for 3 months, and I just started to write and write and write, and I got the Financial Times to agree, and they gave me a copy editor and worked through the whole bit. And in terms of the book, I would say probably just the first chapter is any good today. It's like you can have it, you can buy it on Amazon for like $200. Spare you money, it's not worth it. Okay, like the so much of the gold industry has changed. The only thing that has not changed is the very beginning, the central banks, and my paragraph about the central banks, what do they do, and everything else, and that's still relevant. But everything else, and then there's a chapter on scam. They're the same. I mean, they haven't changed. And like in 30 years, all the scams that you see today in the gold business, they're the same. Apart from that, yeah, not worth it.
So, given that, if you were a novice investor, you wanted to get into the gold market, invest in gold equities, from a learning point of view, where would you direct an investor?
The first thing I would say is, the best, easiest investment that you could make is buy one of the royalty company. A Franco-Nevada, a Wheaton, a Royal Gold in particular. Those are the three largest, most liquid. And given that, my view of the gold price, the optionality, you get the free optionality on price, and you still get the land optionality. I think you will do very, very well. Thank you, Nevada. Thank you. In the case of Franco, if as and when Panama comes back into production, I think the Franco-Nevada stock will probably jump another 20% on top of that. So it's got, a lot of torque to the resolution of Panama. Now, if you want to do a bit more than that, and you say, well, I want a bit more torque, then you can go to, one of the senior, or I would say intermediate company, but I would stop it there. I would not touch the juniors and or the developers. And I say that because if you're a novice and you don't know what you're doing, you're gonna get your shirt, like taken off. Okay, like in the case of developer, maybe they're gonna run out of money, then they have to do more issue, like they haven't calculated the cost of production, and on and on and on. When you buy a producer, at least you know the cost, you know the management, you know the delivery. You can look at a track record. So I would stick with that. And if you have, more money that you want to do, you could buy a gold ETF, just the bullion. Okay, buy kilobar. You can buy them and put them in your safe. That's fine. Or you can buy an ETF on the market, because then you don't have to insure it. You don't have to transport it. You don't have to put it in a safe or whatever. So those are the choices.
What about starting out, Pierre, owning the physical bullion itself before you even jump into the miners to have some physical gold or even some silver if you can't afford the gold?
Yeah, I mean, I've got some gold. It's first of all, it's very pretty. Okay, like it's nice to have, and I like the gold coins and the kilobars, and but you better have a good safe, and you better, have security, and like, do you insure it? And so it comes at a cost. Okay. Um, but yes, you can definitely do that.
All right. Well, Pierre, it's been a pleasure speaking with you again. I hope to do that again in the future. If our listeners would like to follow you, do you post on X or anything like that?
No, I don't have any social media. I'm sorry, but like it's not my thing. I'm happy to come on your show, and if they have any questions, they can like come to you, and then I can, email you some answers. I'm happy to do that.
All right. Well, listen, thank you for being so generous with your time. It's been a pleasure speaking with you.
It's a pleasure, Jim. Thank you so much.
History doesn't repeat, but people sure do. 50 years have passed, the story's still true. Oil and debt rising, see inflation spark, gold shining bright, leading light in the dark. Gold never sleeps, it's the world's honest wall. When the dollar stumbles, gold answers the call. Through storms of the markets, through decades of change, gold never sleeps, it just waits for its range. Central banks awaken, they're buying it fast. A third of the gold, the world's changing at last. The anti-dollar rising, the future's begun. When confidence tumbles, gold has already won. Mistakes I made plenty, but fortune needs time. One winner will lift you, leave all doubts behind. Jurisdictions are shifting, you better stand tall. Have 3 minds to prosper, or risk losing all. Gold never sleeps, it's the world's honest wall. When the dollar stumbles, gold answers the call. So heed all the lessons from cycles gone by. Gold's not just a metal, it's the world's lullaby. So buy what you know, and keep wisdom near. When history whispers, the gold path is clear. No need for a forecast, just look and you'll see. Gold never sleeps, it just waits patiently.
To speak with our financial planning and wealth management team, visit us on our website, financialsensewealth.com. If you aren't already a subscriber to our weekday podcast and would like to listen to more of our content throughout the week, go to Financial Sense and hit the subscribe button.